So today we're going to go over chapter 14, and chapter 14 is dealing with capital budgeting. So the term capital budgeting is used in order to describe how managers plan significant cash outlays on projects that have long-term implications, such as the purchase of new equipment and the introduction of new products. This chapter describes four methods for making these types of investment decisions: the payback method, the net present value method, the internal rate of return method, and the simple rate of return method. So first, let me go ahead and share the screen. So again, capital budgeting decisions, chapter 14. All right, so an overview. So typical capital budgeting decisions. So capital budgeting analysis can be used for any decision that involves an outlay now in order to obtain some future return. Typical capital budgeting decisions would include the lease or buy decisions. So for example, should new equipment be leased or be purchased? Equipment selection decisions, which of several available machines should be purchased? Plant expansion decisions, such as should a new plant or warehouse be purchased to increase our capacity and sales? Equipment replacement decisions, should old equipment be replaced now or later? And cost reduction decisions, which are should new equipment be purchased that would reduce costs? So types of capital budgeting decisions. There are two main types of capital budgeting decisions. One is a screening decision that relate to whether a proposed project passes a preset hurdle. So for example, a company might have a policy of accepting projects only if they promise a return of 20% on their investment. So it has to meet a specific standard. That would be a screening decision. A preference decision would relate to selecting among several competing courses of action. So, for example, a company might consider several different machines to replace an existing machine on their assembly line. So, looking at several different ones and then choosing which one, that would be a preference type decision. Cash flow versus net operating income. So, the payback method, the net present value method, and the internal rate of return method all focus on analyzing cash flows associated with capital investment projects, whereas the simple rate of return method focuses on incremental net operating income. So examples of cash outflows and cash inflows that accompany capital investment projects are as follows. So cash outflows would include the items that we see here. Notice the term working capital, which is defined as current assets less current liabilities. So again, typical cash outflows that would go along with these projects would be maintenance and repair costs, of course, the initial investment, the incremental operating costs, and working capital. And then some typical cash inflows would include the salvage value of a piece of equipment you're getting rid of, what the salvage value is, the reduction of costs that it was going to bring, the incremental revenues, and then the release of working capital. Now, the role of working capital in capital budgeting often confuses students. So the initial investment in working capital at the beginning of a project for items such as inventories is recaptured at the end of the project when working capital is no longer required. Thus, working capital is recognized as a cash outflow at the beginning of the project and as a cash inflow at the end of the project. So just a little bit of a overview and a reminder about the time value of money. So the time value of money concept recognizes that $1 today is going to be worth more than $1 a year from now. Therefore, projects that promise earlier returns are going to be preferred from those that would have later returns. The capital budgeting techniques that best recognize the time value of money are those that involve discounted cash flows. And again, we'll talk more about that when we get, or we talked more about that um, before, or we're going to go over that again in the next section. So the first learning objective is to calculate the payback period of an investment. So the payback method focuses on the payback period, which is the length of time that it takes for a project to recoup its initial cost out of the cost receipts that it generates. And so some key concepts are that the payback method analyzes cash flows. However, it does not consider the time value of money. When the annual net cash inflow is the same every year, then the formula for computing the payback period is shown. So the payback period would be the investment required divided by the annual net cash inflow. And that would tell you how many years it's going to take to pay it back. So let's look at an example, the daily grind. So assume that the management of the daily grind wants to install an espresso bar in its restaurant that has an initial cost of $140,000 and has a 10-year life. The bar will generate annual net cash inflows of $35,000. That's the revenue from what they're going to sell. Management requires a payback period of at least 5 years or less. So what would be the payback of the espresso bar? And so we work that out. We can see how we do that. So the payback would be 4 years because the initial investment is going to be 140,000 divided by the 35,000 each year of revenue generated. So it comes out that the payback period is 4 years. So based on this initial criterion, the management would invest in the espresso bar because its payback period is going to be less than 5 years. So quick check one, finding out what so if we look at these two investments, which project would have the shortest payback period? And it would be Project X because it has a payback period of 2 years. And Project Y has a payback period of more than that, of 3 years. So which product do you think is better? So again, you'd go with whatever one is going to have the shortest payback period. So evaluation of the payback method. So some of the criticisms and shortcomings of it is that the payback period method does not consider the time value of money. It's only looking at how long it's going to take for an investment to be paid back. Also, it ignores the cash flows after the payback period. Thus, it has no inherent mechanism to highlight differences in useful life between investments. We're not considering that. We're just considering how long it's going to take in order to pay back an investment. And in a shorter payback period does not always mean that one investment is more desirable for another. And so, again, if you were going to choose between two different options that each require an initial investment of 4,000, option A would return 1,000 at the end of each of the 4 years, and option B would return the 4,000 at the end of the fourth year. Under the payback methods, options A and B would both be preferable. However, option A is better because the cash flows start earlier. Now add that in year 5, option A would produce an additional cash inflow of 5,000, but that option B will never generate another dollar after the fourth year. And again, thinking about which one would be best, then it would be option A. The payback method ignores the time value of money and does not measure profitability. It only measures the time that's required to recapture the investment. So in that, both of them would have been equal, but then looking at, okay, are we going to get additional than option A because option A is going to have additional. Now, some of the strengths to the payback method are that it serves as a screening tool that helps to identify which investment proposals are in the ballpark. So just to very quickly serve which ones we might want to look at further. It can help companies to compete in industries where products become obsolete rapidly, to identify products that will recoup their initial investment quickly. And it can aid companies that are cash poor in identifying investments that would help to recoup their cash investments quickly. And then again, looking at how we would deal with uneven cash flows. So when the cash flows assigned to each investment project change from year to year, the payback formula that we looked at earlier cannot be used. Instead, an unrecovered investment must be tracked year by year. So for example, if a project requires an initial investment of 4,000 and provides uneven net cash inflows for years 1 through 5 as shown, the investment would be fully recovered in year 4. So it's a $4,000 investment. Year 1, we would get 1,000. We wouldn't get anything in year 2, 2,000 in year 3, and then 1,000 in year 4. So by year 4, it would be paid up completely. So you would, if it's uneven cash flows, you're just going to have to calculate it, figure out for each year, and then you can use that in order to determine that. And one way that you might do this a lot easier is even just if it was something more. I mean, this is pretty easy, but if it was, something more involved, you might, be able to build something in Excel that can help you just, work that out. So the net present value method, that's what we're going to look at now. And how do we look at determining the acceptability of an investment project? So the net present value method compares the present value of a project's cash inflows with the present value of its cash outflows. The difference between these two streams of cash flows are called the net present value. Two simplifying assumptions are usually made in net present value analysis. The first assumption is that all cash flows other than the initial investment would occur at the end of periods. The second assumption is that all cash flows generated by an investment project are immediately reinvested at a rate of return that would be equal to the discount rate. So net present value method, an example using future discount factors from exhibits 14B1 and 14B2. So again, we look at this example with respect to the Lester Company. So Lester Company has been offered a 5-year contract to provide component parts for a large manufacturer. But in doing that, they're going to have to buy special equipment. They're going to have working capital to keep that going. They're going to have to reline the equipment in year 3. And then after year 5, what they would get. So again, taking all of this into account, we're going to look at that. Now, also assume that at the end of the 5 years, the working capital would be released and maybe used elsewhere. So that 100,000 after the 5 years, this is a 5-year contract. So after that, we can release that working capital 100,000 and put it elsewhere. So then, if Lester's discount rate is 11%, should we accept the project? And we figure that out by looking at this, and we say at the starting point, their annual net cash inflow from operations would be 80,000. So their sales revenue was 750. The cost of the part sold was 400,000, and then salaries and shipping was 270,000. So the net annual cash flow would be 80,000. So now, since the investment in equipment 160,000 and working capital 100,000 occur immediately, the discounting factor used is 1. Now, the value factor for an annuity of $1 for 5 years at 11% is 3.696. You'd have to look at a present value table to do that, or utilize Excel to get that. Therefore, the net present value of the annual net cash inflows are 295,600. The present value factor in Appendix 3B are rounded to 3 decimal points. Another approach would be to use Microsoft Excel's NPV function to perform these calculations using unrounded discount factors. Further, the individual net annual cash inflow of 80,000 could be discounted using the related five separate present value of a single payment $1 factors. This value would produce the same present value of 295,680. Now, the net present value factor of $1 for 3 years at 11% is 0.731. Therefore, the present value of the cost of relining the equipment in 3 years is 21,930. The present value factor of $1 for 5 years at 11% is 0.593. Therefore, the present value of the salvage value of the equipment is 2,965, and the present value of the released working capital is 59,300. So the net present value of the investment opportunity is $76,015. So we'll look at another example. So Denny Associates have been offered a 4-year contract to supply the computing requirements for a local bank. So the cost of the computer equipment, the working capital that's required, upgrading the system in 2 years, the salvage value of all the equipment in 4 years, and then what the net value is. And they have to have a 14% return. So we want to know what is the net present value for the bank. And it would, for this contract, it would be 28,230. And again, we do this by figuring out, okay, we know that what the working capital is now, what the investment would be 250,000. So that's straight across. But the annual net cash inflow, 120,000 inflow, there's a total for that, would be, or for each year, would be that. So 120,000, and then the factors 2.914 would be 349,680. And then the cost of upgrading the equipment in year 2 would be 0.7, the factors 0.769. So it would be, and I think they might have used the wrong factor percentage there, but anyway, so the present value would be 28,230. All right. So the net present value method, an example using a discount factor shown in Exhibit 13B1. So again, looking at Lester Corporation. So again, also assume, as of all of this information here, that at the end of the 5 years that the working capital would be released and would be able to be used elsewhere. And their discount rate was 11%. And should they accept the contract? So again, looking at this, since the investments in equipment 160,000 and the working capital of 100,000 recur immediately, then the discount factor would be 1.00. Now, looking at this again, each cash inflow, what it would be, and then we work it out to find out what the present value of that would be, what the scrap value of the equipment, and the working value to be released is. And so we work out then for the annual cash flow. So again, we know that's 80,000, and then at 11%, it would be 0.901 is going to be the factor. So that comes out to 72,080. The same thing for year 3. All right, so the net present value of the investment opportunity is 76,015. Notice that this amount equals the net present value from the earlier approach. So net present value method interpreting the results. Now, once you have computed the net present value, you should interpret the results as follows. A positive net present value indicates that the project's return would exceed the discount rate. A negative net present value indicates that the project's return is less than the discount rate. If the company's minimum required rate of return is used as the discount rate, a project with a positive net present value has a return that exceeds the minimum required rate of return and is therefore acceptable. A project that has a zero net present value has a return that is equal to the minimum required and it would be acceptable. So either if it has zero or has a positive number, both of those would be acceptable. But if it has a negative net present value, has a return that is less than a minimum required return, and then it would be deemed unacceptable. Now, the company's cost of capital is usually regarded as its minimum required rate of return. The cost of capital is the average return that the company must pay to its long-term creditors and shareholders. When the cost of capital is used as a discount rate, it serves as a screening device in net present value analysis and in the recovery of the initial investment. The net present value method automatically provides for the return of the original investment. And so to illustrate this, assume the facts with respect to Carver Hospital. So Carver Hospital, they're looking at buying an attachment for their X-ray machine. The cost is $3,170, but it has a useful life of 4 years, but it's not going to have any salvage value after. The machine is expected to increase the annual cash flow by 1,000, and no investments are made unless there is an annual return of at least 10%. Would we be allowed to invest in the attachment? And so we can work this out, and we can see that what the unrecovered cost is and how much they recover for each year. So the 10% of what they paid out and have, yet to get. And we see that at year 4 that they would have recovered all of their costs. So they just break even on it. But it would be acceptable because since it comes out to zero, it would be acceptable at that point to go ahead and to invest in it. Now, so this implies that the cash inflows are sufficient to recover the $3,170 initial investment and provide exactly a 10% return on the investment. And so it does that. And so because of that, it would be. So you're taking 10% of the amount outstanding. That's where you're getting that. So you're subtracting that from the inflow in order then to come up with how much is being recovered. So doing that, then it would be. So learning objective 3, evaluate the acceptability of an investment project utilizing the internal rate of return method. So key concepts. The internal rate of return is the rate of return promised by an investment project over its useful life. It is sometimes referred to as the yield of the project. The internal rate of return is the discount rate that will result in a net present value of 0. And it works very well if a project's cash flows are identical every year. If the annual cash flows are not identical, a trial and error process must be used to find the internal rate of return. Okay, as we said. So again, it works well if the cash flow will be identical for each year, and of course, will be different. You'll have to use a trial and error process if they're different for each year. Now, if the internal rate of return is equal to or greater than the minimum required rate of return, then the project would be acceptable. If it is less than the required rate of return, then the project would be rejected. When using internal rate of return, the cost of capital acts as a hurdle rate that a project must clear for acceptance. So it has to meet that the cost of capital acts as a hurdle rate. So we find out. So let's look at an example for Decker Company. So Decker Company can purchase a new machine at a cost of $104,320 that will save $20,000 a year in cash operating costs. And a machine has a 10-year life. So since the cash flows are going to be the same for each year, the equation shown can be used to calculate the appropriate present value factor, which should say 5.216. And we see here how we get that. So using the present rate of an annuity of a dollar table, we find out that the internal rate of return equals 14%. So if Decker's minimum required rate of return is equal to or greater than 14%, then the machine can be purchased. So if they're looking to make a 14% investment, when we calculate that out, the investment required over the annual cash flow, we come out to 5.216, and we match that up. So for 10 years, that yields 14%. And so if that's what they're looking to earn, then we can do that. So the expected annual cash flow inflow from a project is 22,000 over the next 5 years. The required investment now for the project is 79,310. What is the internal rate of return for the project? And so you would take 79,319, which is the required investment, and then we'll take divided by 22, divide that into 20, or divide 22,000 into that, comes out to 3.605, and we look at the present value table, then that means that the internal rate of return would be 12%. So comparing the net present value and the internal rate of return methods. Now, the net present value method offers two important advantages over the internal rate of return method. The net present value method is often simpler to use. The internal rate of return makes a questionable assumption that cash inflows can be reinvested at the internal rate of return. So we're assuming that the cash inflows will be invested and can be invested for that. So net present value is easier to use, but if we're using the internal rate of return, we're assuming we can get that. So if the internal rate of return is high, then this assumption may be unrealistic. We may not be able to invest in order somewhere else to get that same kind of return. Now, it is more realistic to assume that the cash flows can be reinvested at the discount rate, which is the underlying assumption of the net present value method. Then we'll take another look at this. So expanding the net present value method. We will now expand the net present value method to include two alternatives. First, we will analyze the alternatives using the total cost approach. Note that all cash flows, inflows, and all cash outflows will be included in the solution under each alternative. No effort will be made to isolate these cash flows that are relevant to the decision and those that are irrelevant. And also that the net present value will be calculated for each alternative. And so one way we can look at it is something called the total cost approach. And so if we assume that White Company has two alternatives, they can remodel an old car wash, or they can remove the old car wash and just go ahead and build up a brand new one. And the company uses a discount rate of 10%. The net annual cash inflows are 60,000 for a new car wash or 45,000 a for the old car wash. In addition, assume the information as shown relates to the installation of a new washer. So if they were going to just put a new washer in there, it would cost 300,000 to do it. It would last for 10 years, have a salvage value of 7,000. They would have to replace the brushes on it at the end of year 6 at a cost of 50,000. And then the salvage value of the old, what's in there currently is 40,000. And if we were to look at the net present value, we come out with 83,202 because we take the initial investment, which is a 300,000 we're going to have to outlay now. The cost to replace the brushes in year 6 of 28,200, which would be the present value of it, but it would cost us 50. But again, working out the present value would be 28,200. The net cash inflows of 60,000 for the year, or 60,000, which is the annual. So that works out to 368,700. The salvage value, which we would get now for taking out the old equipment of 40,000, and a salvage value of the new equipment. So we come out with that. So now, if White chooses to remodel the existing washer, and the remodeling cost would be 175,000, and the cost to replace the brushes at the end of 6 years would be 80,000. So if we look at the net present value of that alternative, we see that again, initial investment would be 175,000. The cost to replace the brushes currently would be 45,120, would be what the net present value of that would be. And then the annual cash flow present value is 276,525. So then the net present value would be 56,406. Excuse me, 405. So if we do that, if they were going to, while both projects yield a positive net present value, the net present value of a new washer alternative is 26,797 higher than remodeling. So they would be better off to go ahead and just start over than they would be to try to remodel. Okay, least cost decisions. So in decisions where revenues are not directly involved, managers should choose the alternative that has the least total cost from a present value perspective. So we'll look at an example. Home furniture company, we will analyze this decision using the total cost approach. So home furniture company, they're deciding whether to overhaul an old delivery truck or to go ahead and just purchase a new one. And the company uses a discount rate of 10%. And so the information pertaining to the old and new truck is as shown. So we see here that overhaul cost of the old truck would be 4,500. The annual operating cost would be 10,000. So probably for, oil and gas and everything else. The salvage value at the end of 5 years would only be 250. The salvage value of it now would be 9,000. And then if they were to go ahead and purchase a new truck, the new truck would cost $21,000. The annual operating cost of that would be less. It would be only 6,000, and it would have a $3,000 salvage value in 5 years. And so if we were to work this out, we would see that the net present value of buying a new truck is negative 32,883. And a net present value of overhauling the old truck is negative 42,255. Now notice that both numbers are negative because there's no revenue involved. This is a least cost decision. So there's no revenue involved. So they're, obviously both of these are going to be cash outlays. Obviously they're going to get a little bit from the salvage value. Um, but anyway, so the net present value in favor of purchasing a new truck is 9,372 because you subtract the 32,883 from the 42,255, and you come out that it's going to be $9,372 cheaper to just go ahead and buy a new truck and do that. So that's why you wonder sometimes businesses they have to make these decisions. Are we going to buy new equipment or are we going to do something to maintain the current equipment? And they use this to figure out, okay, what are they better off doing? And in some cases, they actually are better off to just go ahead and purchase new equipment. And they're better off maybe for other reasons as well. But financially, obviously here we see that it makes better sense. All right, learning objective 4 is to evaluate an investment project that has uncertain cash flows. So handling the complications of uncertain cash flows. So let's, for example, assume that all of the cash flows related to an investment in a super tanker have been estimated except for what its salvage value is going to be in 20 years. And so if we are using a discount rate of 12%, management has determined that the net present value of all of the cash flows, except the salvage value, is negative 1.04 million. So how large would the salvage value need to be in order to make this investment attractive? And if we calculate the net present value that we need to offset, which is 1,040,000, and then what the present value factor is, that is 0.104, then it would be 10 million. So this equation can be used to determine that if the salvage value of the supertanker is at least $10 million, the net present value of the investment would be positive and therefore acceptable. Okay. All right. So while the salvage value is not known with certainty, the $10 million picture offers a useful reference point for making a decision. So again, you're looking at that and figuring, well, do you think that there's any way that they could get that? And, they would have to consider that. Okay, quick check number 4, dealing with this. So Bay Architects is considering a drafting machine that would cost $100,000. It would last 4 years. It would provide an annual cash savings of $10,000, and it would be uh, and considerable intangible benefits each year. How large in cash terms would the tangible benefits have to be per year, or the intangible benefits have to be per year to justify investing in the machine if the discount rate was 14%? And so the investment in the machine is going to be 100,000. The present value of the cash inflows are going to be 29,140. So that's what we're trying to figure out. And the net present value would be 70,000. And we can calculate that. So they would have to be 24,317 would have to be what the value of the intangibles would be. Okay, so now we'll learn how to rank investment projects in order of preference. So if we remember when we're considering investment opportunities, managers must make 2 types of decisions, both screening decisions and preference decisions. And screening decisions are what come first. They pertain to whether or not some proposed investment is acceptable. And then preference decisions then attempt to rank the acceptable alternatives from the most to the least appealing. Preference decisions need to be made because the number of acceptable investment alternatives usually exceeds the amount of available funds that we have to invest. And so we can use the internal rate of return method. And when using the internal rate of return method to rank competing investment projects, the preference rule is the higher the internal rate of return, the more desirable the project. We can also use the net present value method. And with that, we are looking at the net present value of one project cannot be directly compared to the net present value of another project unless the investments are equal. So this is going to be difficult. So if they are unequal investments, which in most cases they will be, you will use what is called a project profitability index that will be computed by taking the net present value of the project dividing over the investment required. And so we can get that. So we look here that project A has a profitability index of 0.10, and project B has a profitability index of 0.2. And so we see here that the higher the profitability index, the more desirable the project would be. And since in this type of situation, the constrained resource is going to be the limited funds that were available for investment, the project profitability index is similar to the contribution margin per unit of the constrained resource that we discussed in an earlier chapter. Okay. Then we'll look now at computing the simple rate of return for an investment. So first of all, the simple rate of return method, also referred to as the accounting rate of return or the unadjusted rate of return, does not focus on cash flows. Rather, it focuses on accounting net operating income. The equation for computing this simple rate is as shown. So it is the annual incremental net operating income over the initial investment. And remember that the initial investment should be reduced by any salvage from the sale of the old equipment. And so we can look at an example. So assume that the management of the Daily Grind want to install an espresso bar at its restaurant. The cost of the espresso bar is $140,000 and has a 10-year life. The espresso bar will generate incremental revenue of $100,000 and incremental expenses of $65,000, including depreciation. So what is the simple rate of return on the investment? And so if we take 35,000, which is, I think where they got that. I guess it's the difference there. And divided over the cost, we get 25%. But some criticisms of this simple rate of return is that it ignores the aspect of the time value of money. And the simple rate of return fluctuates from year to year when used to evaluate projects that do not have constant annual incremental revenues and expenses. So the same project might appear desirable in some years and undesirable in others. And in the behavioral implications of the simple rate of return. So when investment center managers are evaluated using rate of return on investment or ROI, a project's simple rate of return may motivate them to bypass investment opportunities that earn positive net present values, because again, we're just looking at one aspect of it. Okay, post-audit of investment projects. A post-audit is a follow-up after the project has been completed to see whether or not the expected return results have been actually realized. And the data used in the post-audit analysis should be the actual observed data rather than estimated data. So after everything's all said and done, you're going to go back and, you've done a project and you've completed it, then it's important to still go back and analyze, what happened, what the results were, and see if it met what you had expected.